Hello, fellow traders. Today we're going to be talking about the stock, or I guess in this case ETF, that I think it has the most potential couple of weeks down the road. Today I pick HUV.to. This is a ETF, a short-term ETF. Pretty much tracks the inverse of SP 500, and as you can see, it's been nearing the 52-week low. This would be a really good play. I'm gonna explain a bit of reasoning as to why I think this is a good play. Let's just look at the chart here. We can see that MACD's it's giving a signal actually to buy already. It's been coming down, just like a lot of Beta Pro, including the crude oil ETF that I used to take a position in. It all went down crazy like this. Anyway, the point is, it makes sense because SP 500 has been historically good, and tracking the inverse of that, of course you're gonna get a constant decline. Here now, today trading at 4.04, down 1.94%. One of the biggest thing about stock market is that it won't always go like this. Even you guys can see, even with the decline, there's still some up and downs. You see right there, this was back in October to December. It was really bad. Market was in a really bad shape. That historically bad day for SP 500 or overall market, and then that historically good, I believe it was December 25th, a really historic day for the market right after. And the reason why I think this is a really good play, because SP 500, Dow Jones, Nasdaq, they all just reached their all-time high. Now we don't know how high and continuous it's gonna go. Eventually we can expect some pullbacks. What does pullback mean? A pullback can range anything from going down, say 1/3 or even 2/3 of initial surge. We see that all the time in market trends, and we can expect to see one really soon, I believe. With this week's earning coming up, it's really good to observe how market reacts to their earning itself and the federal rate cut, which is promised, I guess hinted and priced in by the market. Now, the yield curve, last time I checked, it has already been inversed for 4 months now. It first inverted in March. That is when the long-term interest rate dipped below, the yield rate dipped below the short term, and that's been historically accurate. They said that it shouldn't be, I guess, an indication, like 100% indication. Nothing is 100% in the market, but it has been accurate, I believe, 7 out of 7 times. Last time it happened, it was 2007, I believe, or 6. It usually takes an average of 12 months after it happened, after it inverted, for us to be in a recession. Now, the reason why I think there's going to be a huge market crash coming between, I guess, either March of next year or June of next year is because, now, first, obviously, yield curve inverted on March, and like I said before, it took average of 12 months for us to actually be in a recession, and that's gonna be next March. And the reason why I say it might be June of next year is because this is what I heard from our podcast, is that we need to wait till it actually holds the inverted state for us to conclude that, hey, this is actually a pattern forming, instead of just it appeared and went back up again and not inverted again. So usually waiting a good 2-3 months it's good to see if the pattern holds, and it did hold, which is why I think June 2020 is gonna be the time when everything just gone to hell, and it will be a really good time to buy puts. Now, for the second piece of news I want to bring to you guys is, let's move this, the fact that this earning week is going to be nuts. It's going to be really, really good. The reason why I say this, look, so many big brands are up there. Visa, Snap, TD Ameritrade, I think it happened today or something. The ones I pay the most attention to are Boeing and Facebook, and maybe Tesla. I'm curious to see how Tesla is gonna do. These are all huge companies, and I personally believe that Facebook and Boeing, they will beat the earnings, since it has been lower so much. The estimates has been lower so much that pretty much majority of the company, they are saying that their earnings will be hurt because the growth is slowing, and then the Wall Street analyst factor all this in and give a really low estimates compared to a normal I guess economic trend. And once you lower the expectation, it becomes easier to beat. If you take a look at Boeing, there is estimated earning per share, it's super low compared to previous years. I know that there's been a lot of grounding, a lot of issues with I guess just their overall plane parts and software, and they decided to lower that to something, I believe, like 1.9 or something, compared to I guess it was like 4 or something for earning per share. It's looking pretty decent for this. I personally have position in Boeing, and I'm gonna try to play earning by holding it through the earning call. We'll see what happens then. And a couple of other ones, Amazon.com, McDonald's, UPS. This is something that I'm curious about. Ever since Amazon taking over, starting to take over the delivery logistic route, UPS and FedEx, they have been on a decline. We'll see if this really it will say something about how much has changed in terms of the business fundamentals, as well as the numbers that Wall Street guys and all of us truly care about. McDonald's, I've been trying to wait for the dip to buy McDonald's. I walk into McDonald's a lot of times, and it's pretty much full all the time. you don't lose money that way. You get so much profit, and you can just keep opening up restaurants all over the world, which they're already doing. We'll see how it plays out in this week's earning. It's jam-packed. It really is jam-packed. And that's it for today's video. If you guys liked the video, please comment, like, and subscribe. And remember to stay hungry and be resilient. And I will see you guys next time. Bye bye.